Morning to you all. I'd like to start today by just very briefly thanking Paul and the IFS for introducing us yet again and getting us involved in the Green Budget. I would also like to echo Paul's thanks to the sponsors as well for making such a great event happen once again. In terms of the economic outlook, this is I suppose, quite an unusual time for me to be standing here and sort of talking about this. We've got probably 20 minutes to fit in probably more content than I've ever had to contemplate fitting in before into such a short time period. Certainly in previous Green Budgets, we've never come off the back of as eventful a year as 2016 was. But in terms of those that tumultuous year we've just gone through, very much all of the sort of events that we've seen have been political events. And in terms of the macroeconomic picture, or certainly in terms of the very top level performance in terms of GDP growth, it's actually been a pretty uneventful year. The chart that I've showed here actually shows you how the forecasts for not just Oxford Economics, but also the consensus of economists surveyed by the Treasury have evolved over the past year. And certainly since the financial crisis, I can't remember a year where the forecasts were so stable throughout the whole year. This time last year, I said that we thought that growth would be probably 2% or just above. In the end, growth was 2%. And virtually all economists were pretty aligned on that for most of the year. Now, obviously, there was that big wobble post-June 23rd. Some of our peers got a little bit more excitable than others, and some forecasts did drop quite substantially. But by and large, most economists will continue to expect growth to be around 2% for most of the year. Now, in some respects, 2016 was probably a little bit easier to forecast because a lot of those events happened in the second half of the year, so it had sort of less impact on growth rates for the year as a whole. And I think 2017 is going to be much more challenging, as I'll show you over the course of the next 20 minutes or so. However, I think one of the things that we've come to learn over the last 6 months in particular is that virtually everything at the moment is seen through the lens of Brexit. There's an almost ongoing conversation about whether good or bad data is because of or in spite of Brexit. And I think that obsession with Brexit that we've developed does risk masking some very important structural stories that are actually bubbling under in the economy. And I think certainly we've been focusing more on some of those other stories than a specific Brexit effect per se. Now, in terms of those underlying stories, I think this is the chart that concerns us most heading into 2017. This chart shows us the way that growth was achieved in 2016 based upon the expenditure components of GDP. This is based upon 3/4 of data and 1/4 of our forecasts. And as you can see from that chart, it's pretty stark. Virtually all of the growth we had last year came from the consumer. And indeed, if you actually look at why the economy did so well in the second half of the year in particular, and why it did maybe better than some people expected, it was largely because the consumer kept spending in the face of what was already, at that stage, a squeeze on their personal finances. So I think that really lends us pushes us towards two key questions going into 2017. First of those questions is, can the consumer continue to do more than its fair share? Can it continue to carry the rest of the economy on its back? And if the answer to that question is no, the second question obviously then is, what can we actually expect to come through and to fill the void left by the consumer? Now, in terms of 2017 and the way things pan out, we think this chart is going to be key to the way that things develop, not just for the consumer, but also other sectors of the economy. We've had a substantial depreciation of the pound, not just since the 23rd of June last year, but also this was particularly against the dollar, something that was set in train a lot earlier. We've been depreciating really since the middle of 2015. And we see this as being something that's going to shape fortunes going forwards. If you look at where we are now compared to that middle of 2015 figure, we're about 20% weaker now, the sterling against the dollar, than we were before, and even against the euro, a currency that has by and large struggled for the last 2 or 3 years. We're still 17% weaker than back then. Now, we see this as being a particularly important thing because of what it's likely to do to inflation this year. As far as we can tell, so far, the impact of that weaker pound on inflation has been pretty muted. Now, we think that the step up in inflation we've seen over the last 5 or 6 months is largely a function of both base effects, so that the big falls in food, energy and oil prices at the end of 2015 weren't repeated last year. And it's also a function of the fact that the oil price rose quite substantially through 2016. We think that very little of the depreciation, particularly that post-referendum depreciation, has come through yet. Now, when you look at the economic literature on depreciations, they tend to tell you that these things come through after about a year. So the maximum impact is felt after about a year, which, as far as we're concerned, suggests that when we get to the second half of this year in particular, you are likely to see inflation rates getting up to somewhere approaching 3%. Now, obviously, given that sort of consumer strength we've seen over the past couple of years has been founded upon inflation being, for the most part, below 1%, that represents quite a substantial turnaround for the consumer sector. Now, we are a little bit more optimistic that wage growth can do more of the work, more of the heavy lifting, and actually support consumer spending power. That's largely because the labour market is very tight, and we're seeing now evidence that, in particular, sort of people are becoming more emboldened to actually move jobs, and job shifting tends to be quite a positive for wage growth. But I think in terms of being more positive about wage growth, we're suggesting that might mean a step up from the low 2s to somewhere closer to 3%, rather than a sort of step back towards the pre-crisis norms of 4.5% to 5%. So I think if you take the sort of two factors together, that does suggest that there's going to be quite a substantial squeeze on real wages this year. And that, I think, certainly undermines the case for the consumer to continuing to grow at the rates it has done. Something else that also sort of pushes against the consumer is the fact that over the last couple of years, strong household income growth has partly been due to very strong employment growth. Again, because of the tightness of the labour market, but also because of the fact that we think momentum is going to ebb this year. We think employment growth will be weaker this year. And also you have to factor in, for those who are on state benefits, the fact that we're now into, I think, the second year of a 4-year freeze upon most working age benefits. And obviously that sort of cash terms freeze that was introduced a couple of years ago becomes that much more punitive now that inflation is higher than the government expected it to be. So when you push all of those factors together, what you get is a picture that's shown on that chart there. You have a blue line, real household disposable income, which is growing very, very slowly over the course of not just this year, but also into 2018 as well. So we really are moving from a situation where incomes were growing by sort of 2.5%, 3% a year to one where we're barely getting any growth at all. Now, the Bank of England put a new forecast out last week, and they suggested that what consumers may be able to do is to borrow more, to lean against those pressures on their incomes. But I think it's fair to say we're more pessimistic than the bank about the ability and also the willingness of the consumers to actually do that. We're already in a situation now where, even as we stand before that big inflation increase has happened, consumers are already spending more than they're actually earning. So we think the scope for them to continue to do that as inflation gets ever higher still is pretty limited. So we expect consumer spending growth to slow throughout the course of this year, and for the toughest part really for the consumers to be in the second half of 2017. That's where we see things troughing. Now obviously consumer spending, 60% of the UK economy, that represents quite a sort of chunk of growth that we need to try and find elsewhere. So I want to now look at some of the prospects for some of the other expenditure components. Now, one area where we've always been fairly optimistic and where our expectations have been regularly disappointed is the business sector. You'll go back to that chart I showed towards the start there, and you see that business investment is likely to have fallen by about 1.5% last year. So that's actually detracted from growth. Now, that comes despite what is, in terms of the financial backdrop, quite a positive picture for corporates. I think pretty much at every one of these green budget presentations I've given over the last 4 or 5 years, I've probably shown the same two charts and said that the corporate sector is in fantastic financial shape. It has profitability that's well above historical norms. It has enormous amounts of cash sitting on balance sheets, being completely unused, not being put to good effect. Credit conditions are that much more sort of helpful towards companies, even smaller companies now, than they were, say, 2, 3, 4 years ago. So all of the sort of backdrop is there in terms of the ability of companies to go forth and invest. The big challenge, as it has been for much of the last few years, is that companies just don't simply want to at the moment. This chart here shows two of the main sort of measures of investment intentions. We've weighted together the manufacturing and services balances to try and give you a sort of sense of a whole economy figure. And you can see that even prior to the referendum in the middle of last year, investment intentions were already heading south at quite a rate. And now are pretty weak levels. In fact, they're back at the sort of levels that they last were in the Eurozone crisis of 2011-2012. Now, as I say, I don't think this is entirely a Brexit story. Certainly the big sort of move downwards does certainly predate the referendum. But I think certainly with Brexit there as a backdrop, it's very difficult to see companies, particularly those companies that have quite high exposure to European markets, becoming that much more bullish about investing until they know a lot more about how things are likely to develop in terms of Brexit. So though we expect to see over the course of the next few years investment certainly not falling as it has done over the past couple of years, we certainly don't expect it to get back to the sort of rates where it could have a meaningful impact on GDP growth going forwards. So if we're not going to get much from investment, what can we get elsewhere? In terms of the government sector, I think there our expectations are equally low. I think we've become so accustomed to austerity over the years that we almost sort of forget that austerity is going on. We're now 7 years into the government's austerity plan, and as that chart there shows, we have quite substantial austerity still to come. And indeed, over the course of the next 3 years, if you believe the OBR's forecast for the structural deficit and how that's likely to change over that period, we are actually coming into a period where the degree of austerity is actually that much greater than what we've seen previously. So fiscal policy as a whole is likely to be quite a substantial drag, and as far as the OBR are concerned, a drag of something in the approaching sort of 0.75% a year on GDP going forwards. So in terms of sort of we're looking for these sort of things that may fill the consumer void, it is very much the case that the government sector is unlikely to provide much help, and indeed is actually going to be an active drag on growth for the next few years. Now, given what we've sort of said about the sort of weaker pound and how much that may be important, the obvious sort of candidate in terms of looking for greater support for the economy would be exports. And certainly, I think if you look at the business surveys, there is some sort of hope that exports are starting to now come through and starting to pick up, and may well start to fill some of the void. The big challenge, though, for us economists is that although the export data is looking reasonably good from the survey side, in terms of the official data, the picture is significantly weaker. The chart on the right there shows that on a year-on-year basis, non-oil export volumes are actually still falling. So certainly in terms of the official data, there hasn't been much of a sort of feed-through yet. Now, why is that disparity there? We think that disparity is largely because sort of the two sort of the survey and the official data are looking at slightly different things, and they're not quite capturing the sort of subtle change in behaviour that we're seeing amongst companies. What seems to have happened so far is that companies have seen that big depreciation in sterling, they've kept their foreign currency prices the same, and they've effectively taken a big boost to their profitability. Now that's great in terms of what it means for company profits, because obviously that means that their sort of the profitability of their sales to non-UK markets is that much stronger. But what it doesn't mean is it means that they're not gaining the sort of increase in market share that maybe you might typically expect when you have that sort of depreciation. Certainly previous depreciations, and certainly examples of other countries that have seen this happen, companies there have been much quicker to actually reduce their foreign currency prices and really trying to sort of eat into market share that way. Now, we think this will continue, which means that will actually decrease the amount to which that sort of weaker pound will actually help net trade. But I think what we may see is we may see a sort of slightly subtler benefit of that sort of behaviour, because if companies do continue to engage in this behaviour, what it means is that corporate profitability should be a bit stronger. That then obviously provides yet more funds for investment. Obviously, it still requires them to actually go out there and spend it. And what it also should mean is that it should mean much stronger dividend payments to households as well. So I think our sort of view on that is all is not lost in that sort of terms, but the way that companies are behaving at the moment suggests a much less direct and probably a smaller impact sort of through the net trade channel. One area where we are a bit more optimistic about exports is in terms of what's actually happening to our key trading partners. And in the most part, that sort of more optimistic take is largely because of the changes in policy that we're expecting in the US. Now, there's been a huge amount, obviously, about the US in the media over the last couple of months since President Trump won the election in November. Our view on on how things are likely to play out is that we think he will enact most of the sort of pro-growth policies. In particular, that we do think he will put in place a material increase in infrastructure spending, that he will also reduce tax on business, and that should have a stimulative impact on the US economy. However, a lot of those sort of measures are unlikely to come into play until the second half of this year at the earliest. So any boost that we're likely to see to the US economy, as the growth rates there sort of will show, they tend to come through towards the second half of this year and into 2018. Elsewhere in the world, I think the Eurozone economy we still think is fundamentally fairly strong. However, in the short term, it's likely to face the same sort of headwinds that we are in the UK from higher inflation. It's also obviously sort of suffering from what's happened to energy prices, but it's also because of the weaker euro against the dollar, is also sort of feeling some of the pressures from input costs. And though the sort of situation in emerging markets such as China may be sort of, we may see a sort of slight deceleration over the course of the next couple of years, in terms of what it means for the UK, because we do so much more trade with those sort of countries on the left-hand side of that chart there, in particular the US and the Eurozone, we actually think that the global backdrop will be more supportive of UK exports going forwards. So when we put those sort of factors together, what it leaves us with is a forecast for the next couple of years, which looks a little bit like this in terms of those expenditure components. You can see in 2017, 2018, 2019, that contribution from the consumer is significantly weaker because of all of the sort of pressures that I've mentioned earlier. We do have a little bit of an offset from net trade. Certainly, I think it helps that net trade is no longer likely to detract from growth over the next couple of years. But I think given its relative size and given what I've said about the way that firms have actually behaved sort of in the face of that depreciation, we think that the best we can hope for is it to contribute maybe a couple of tenths of a percent this year, and maybe about half a percentage point next year. We certainly don't think it can contribute enough to fully offset the drag from weaker consumer spending growth. Now, we think things will pick up as we go through the forecast period, mainly because as we get towards the end of the period, that 4-year cash freeze on most working age benefits actually expires, and we move back, we assume, to a more normal system of uprating. And also, obviously, those sort of pressures from high inflation, they gradually wash through the system over the course of the next couple of years. But I think certainly the message in terms of the short-term outlook here is that we don't think we can expect sort of the economy to achieve the sort of growth rates it has done over the last couple of years over the next 2 or 3 years. Our forecast shows growth of about 1.6% in 2017 and around 1.3% in 2018. Now, in terms of where that forecast sits, this is a version of the chart that I showed earlier on, but for 2017 this time. And as you can see, we didn't downgrade quite as much as quite a few other people did in the immediate aftermath of the referendum. And by and large, we've stayed above the market consensus throughout 2017. Now, at the moment, our sort of forecast of 1.6% is about 0.2, 0.3% above the consensus. I suspect over the course of the next couple of months, the consensus will gradually start to actually increase and converge on our forecast. That's partly because it would require the data to be quite a bit weaker than it has been over the last sort of few months for that consensus forecast to actually hold. It's also because the Bank of England came out with a forecast last week of 2% for this year, and certainly there is a tendency for people to follow the crowd. And over the course of the next couple of months, you would expect to see quite a few forecasters sort of have a little think about it and think, well, if the bank thinks 2% is realistic, maybe I'm a little bit too pessimistic myself. That's the short-term outlook. Where do we go beyond that? In the Green Budget, we've as usual, provided quite a lengthy commentary on the medium-term outlook, echoing the sort of time period that the OBR do, so out to 2021. In terms of that period to 2021, I think the first important thing to actually sort of state is that even across sort of a period that's that long, so out effectively the best part of 5 years, Brexit isn't really that much of an issue in terms of the medium-term outlook. That's partly because we assume in our forecast that the government is successful in its aims of having both a transitional agreement, but then following that a free trade agreement with the EU. Now that means that obviously if you have a transitional agreement that lasts maybe 2 to 3 years, the vast majority of that period out to 2021 will still be within that transitional agreement, so not a huge amount will change as far as we can see. It's also partly because, as I'll show you in a minute, we think a lot of the sort of the potentially negative effects of Brexit will play out over a much longer time frame than 2021. Quite simply, there isn't enough time there for those sort of effects to really start to emerge and to come through. That said, we are still pretty gloomy about prospects for the next 5 years if you place our forecast in the context of what might have been normal prior to the financial crisis. Prior to the financial crisis, we had output growth of about 2.7% a year, so about 2.75% a year. We estimate that we've had a potential output growth of about 1.6% a year in the 10 years since. That's a little bit above where the OBR are. The OBR are at about 1.3% there. And the big contrast between us and the OBR is that we think that those weaker growth rates will continue over the next 5 years as well. Now, there's two sort of main factors there that are sort of effectively dragging our forecast down for the next few years. The first of those is what's happening to the labour supply. The strength of the last sort of few years in terms of the way that labour has been contributing to economic growth has been partly founded upon very high levels of immigration and it's also been partly founded upon successive, very large increases in the female state pension age. What we see over the next 5 years is that we think the levels of immigration will come down, and that's not, again, not a Brexit effect, but that's just simply the fact that if unemployment is coming down in the European Union and in some of the other countries where immigrants come from, that tends to reduce the incentives for immigrants to move to the UK. And our forecast assumes that will happen and that those incentives will become progressively more dulled over time. Alongside that, we are coming to the end of those increases in the state pension age. By the time we get to 2020, the state pension age will be 66 for both men and women. And those increases in the labour supply have been pretty powerful over the last few years. So losing that sort of crutch of an increasing increasing working age population will represent, we think, quite a substantial drag, particularly when you get to that sort of back half of the period. The other factor that was particularly strong support to growth prior to the financial crisis was what we've called human capital here. Now, human capital effectively is the quality of the labour supply. It's the amount of knowledge that the labour supply has. And that was boosted quite substantially prior to 2007 by that huge increase in university admissions. Firstly, as a result of the switch from polytechnics to universities in the 1990s, and then latterly the Labour government of the late 1990s increasing substantially the amount of people going to university. We're now over that hump, we think, of university admissions. So that also provides less in the way of contributions to growth going forwards. Now, we think there will be some offset from a greater contribution from the capital stock. That's because we think business investment will gradually grind its way upwards over the course of the next 5 years. And we think the legacy effects on productivity growth will gradually ease as well. But those two positive factors, all they do is mitigate the two negative factors that I mentioned earlier on. And what we get is effectively a continuation of that very weak growth and potential output of about 1.5% going forwards. Now, I mentioned that we don't really see Brexit as being a big issue on that timescale. Where we do see Brexit as being much more of an issue is when you move further out. And in terms of our timescale here, we're looking more at 2030. Now, again, there's quite a detailed analysis of this in the Green Budget book. And also, most of this material comes from a study that we put out last March. But the key as far as we're concerned, is it matters a little bit less as to whether we secure anything in terms of a free trade agreement, in terms of tariff-free trade. What matters much more is what we can agree in terms of non-tariff barriers and also in terms of the customs arrangements. And on both of those, we are relatively gloomy. We think that over time, regulatory differences will result in non-tariff barriers becoming much more of an issue, and it will make it much harder for us to export to the European Union. And we're also relatively downbeat about the prospects for having, I think, what the Prime Minister has called frictionless trade. I think it's going to be very difficult to get the European Union to agree to having very low-level customs checks. And certainly a lot of the literature on the impact of customs checks suggests that can be particularly damaging in terms of the amount of extra admin costs and also the extra difficulty in exporting. So over the longer term, we think that the government's chosen path for Brexit is actually one of the more economically damaging. And in fact, the only outcome that we've studied that which actually would be worse than what the government has chosen would be us actually not coming to an agreement at all, falling out into WTO rules. But I think if we actually look at that chart there and actually compare the relative performance across those scenarios, that descent into WTO rules wouldn't actually be that much worse than the baseline forecast of a free trade agreement. We could effectively save ourselves there. We could end up with much stronger outcomes were we to change course and go back for something that looks more like the status quo. And also, I think intriguingly, and this is probably the bit that's more up for discussion, we could also save ourselves were we to enact all of the newfound freedoms and policies that we get in a more liberal fashion. So we've assumed that by repatriating immigration policy, the government will then operate that immigration policy relatively tightly. If the government actually took a more liberal approach, we think the outcomes would be better. But just to sum up then, in terms of the economic outlook, I think for the course of the next couple of years, we do expect weaker growth, principally because of what's happening to the consumer sector. Medium term, relatively gloomy, but that's more a function of what's happening to the labour supply rather than what's happening to Brexit. But certainly if you extend the forecast out further and go out towards 2030, that's where we see the Brexit effects really coming through. Thank you very much.